Hello, Super Saver. So, is your bank safe right now? I've gotten that question a lot recently. Or is your bank heading for or already in potential trouble like regional bank First Republic, which recently announced massive declines across several key performance indicators in their first quarter earnings release? Will First Republic survive this week, this banking crisis? And that's what we'll be talking about in today's video. The 5 signs that your bank may be in trouble and what you can do to put your mind at ease during this banking crisis. As always, 1, I don't have a crystal ball. What I'm sharing with you is based on my analysis and interpretation of publicly available data, which I've linked in the description below if you're interested. All opinions and forward-looking statements in this video are as of the date of this recording and subject to change. 2, past performance is not necessarily indicative of future results or events. And 3, this content is not sponsored by any of the companies mentioned in this video, nor do we receive any compensation if you choose to do business with any of them. For a detailed disclaimer, please refer to the end of this video. Now, let's dive in. Deposits are key in the current banking crisis, and the number that many of us in the industry are watching, because I can tell you that the answer to this question is most probably yes, your bank's deposits are going down. As I mentioned in an earlier video, many folks, including the super savers on this channel, withdrew their bank deposits in 2022 as the Fed hiked rates by a mind-boggling 4.25%, and investments like T-bills, CDs, and money market funds started showing more attractive rates. And this can be seen even more dramatically since the fall of Silicon Valley Bank here. Between March 8th and mid-April, more than $400 billion of deposits have flowed out of our banking system. And this time around, it was less about rates and all about safety and trust, as many of us know. Now, to be certain, some of the biggest banks in our country benefited from SVB's collapse in the sense that they were the recipients of the uninsured deposits that fled SVB and other banks that were perceived to be less safe. But even with these inflows, deposits at these larger financial institutions were still down year over year, as you can see here, with Citibank as the one exception, where deposits were flat. For those of you who've watched this GSIB video, which I've linked in the description below, JP Morgan Chase, Citibank, Wells Fargo, and Bank of America are 4 of the GSIBs, global systemically important banks, that we consider to be among the 8 safest banks in the US. And we chose these 4 GSIBs for this analysis primarily because they were the first 4 comparable ones to report their earnings in April. All these numbers are based on what's been publicly released in April for the quarter ended March 31st, 2023. The one exception is here, where the numbers are for the year ended December 31st, 2022. That's the most current publicly available data at the time of this taping. Right, so other than Citibank, deposits were down everywhere. Bad enough, but they were down a lot at regional bank First Republic, FRB for short. Here's what the year-over-year deposit decline looked like for FRB. Pretty brutal. It's no wonder that First Republic stock tanked by 50% less than 24 hours after they publicly released their first quarter earnings with an update on these deposit outflows here. Do note that to make this an apples-to-apples comparison, FRB's $74 billion of deposits excludes the $30 billion lifeline that was handed over to them by 11 of the biggest U.S. banks in March, shortly after SVB collapsed. In fact, these 4 GSIBs here combined contributed 2/3 of that $30 billion lifeline, with each agreeing to put $5 billion of uninsured deposits into First Republic. Now that the first quarter 2023 earnings numbers are out for many of the leading banks, it's completely unclear whether or not First Republic would have been the 3rd bank to fail after SVB and Signature Bank had the other bigger financial players not thrown them this $30 billion lifeline. So, Are your bank's deposits going down? If yes, that could be the first troubling sign. But given that this downward trend can be seen at practically all the banks, unless the decline is super dramatic like at FRB, declining deposits alone may not be enough to tell you whether your bank is in trouble. So let's move on to troubling sign number 2. On the most basic level, net interest margin, NIM for short, is the difference between what your bank earns in interest from its borrowers minus what it pays you and other depositors for your deposits, measured as a percentage of the average value of its interest earning assets. So the higher the NIM, the better the bank is doing. And here's what the NIM looked like for JP, Citi, Wells, and B of A in the first quarter, as well as the year-over-year change. And here's what it looked like for FRB. What this tells us is that even though deposits have become more expensive for the banking industry in general, remember the attractive rates for savers that we've been showing on this channel since last year. These 4 GSIBs here were able to more than compensate for that increase in deposit rates by earning even more on their assets. For example, by charging higher interest rates on credit cards and other floating rate lending, as well as extending new loans only at higher rates. In fact, many well-run banks have found over past cycles that higher rates can be short-term painful when they have to pay more for scarce deposits, but may be overall beneficial to their bottom line as lending rates increase as well. First Republic is a different story. A net interest margin declining by 34%, combined with its much, much lower deposit number, that's 2 red flags already for them. Now, let's move on to the third red flag. That is the ultimate question after all, right? Because at the end of the day, a bank is a business. And if a business doesn't make money, well, eventually it'll be gone. Plus, a sound profit can also generate cash that the bank will have a good use for in these challenging times. And boy, did JP, Citi, Wells, and B of A surprise Wall Street with their net income, the money they made after expenses were deducted in the first 3 months of this year. And it was very much a positive surprise from increased profits, as you can see here. Now, if you're wondering how this might be possible despite the decline in deposits, as I've just explained above, in a nutshell, many of these big banks have lines of business which allow them to also profit from higher interest rates when properly managed, such as credit cards and other floating rate loans. These banks, including the largest ones, will also derive substantial income from business lines that are not directly linked to interest rates, such as foreign exchange and payment services, trading, and brokerage services, as well as private banking and asset management products that charge a direct fee to the client. Unfortunately, once again, this was not the case for First Republic, whose net income dropped by about a third year over year. FRB is now 3 out of 3 on our list of troubling signs. Let's see how the rest of this plays out. Loan loss provisions are the amounts that your bank sets aside to cover the loss from possible future defaults on loan payments. Because what happens when times are bad? People lose their jobs or have less money in general, and the chances of loan defaults increases when individuals or companies find themselves unable to pay their monthly rates on a loan they took out when times were better. Setting aside more money to cover possible loan defaults before the actual downtimes hit is prudent and necessary for banks so they are not caught by surprise when borrowers don't pay back what they're supposed to when they're supposed to. And in this case, it seems all the banks, including First Republic, have indeed increased their loan loss provisions. Bank of America, in fact, increased their loan loss provisions by a whopping 3,000+%. No surprise, really, given that the bank's CEO, Brian Moynihan, on their earnings call to investors and analysts, did bring up the possibility of a likely recession starting as early as the third quarter of this year, so around summertime. As for Wells Fargo, they set aside a respectable $1.2 billion in the first quarter of 2023 for possible future loan losses. However, as you can see here, there is no real percentage comparison to what they did a year ago. And this is for the simple reason that a year ago, Wells Fargo didn't put any new money into the reserves for possible future loan losses. On the contrary, they even took out some of the money they had set aside before. But that could be an entire video on its own. If B of A CEO is correct, and we do see a recession later this year, loan losses will become a big topic to watch. Drop me a comment below if you're interested in diving deeper into how the whole mechanism works for loan loss provisions and charge-offs or reversals. So, if your bank's loan loss provisions haven't gone up this past quarter, then this may be a sign of looming trouble because they're either expecting better economic times in the near future, which I'll be honest, I don't, but again, that's a topic for a different day. Or in the worst case scenario, your bank will be very unpleasantly surprised when they're hit with higher loan defaults if and when the economy dips further. I talked extensively about unrealized losses on held-to-maturity assets as a percentage of total shareholders' equity in this recent video, and how this ticking time bomb in safe U.S. Treasuries may cause a bank, maybe even your bank, to fail. Unrealized losses on held-to-maturity assets refer to the losses that a bank would incur when it has to sell long-dated, low-interest earning treasuries and other liquid safe investments that were intended to be held to maturity before maturity to meet unexpected immediate cash needs. And in the current rising interest rate environment, such emergency sales will usually incur a large loss, as the market price of these long-dated, low-interest earning bonds will have fallen sharply in most cases, as some of our super savers in the community can attest to themselves. And total shareholders' equity is basically the total amount of money that shareholders, investors, have put into that bank to support its growth. When it comes to unrealized losses as a percentage of total shareholders' equity, what you basically need to know is that the lower the percentage, the better. In this instance, First Republic's percentage is the second highest after B of A. But what you should know is that this B of A number is somewhat misleading in the sense that B of A has been stressing on its investor and analyst calls that the real number after hedges is much smaller and not really a threat to the bank's economic health. First Republic, on the other hand, has not been talking much about hedges to its portfolio, so most market observers tend to assume that there probably aren't many in place. Finally, do note that the numbers in this row for unrealized losses as a percentage of total shareholders' equity are as of December 31st, 2022, because as I mentioned earlier, that's the latest publicly available data on unrealized losses on held-to-maturity assets for many of these financial institutions. The March 31st, 2023 numbers should be available around early May. Unrealized losses on held-to-maturity assets is a fairly complex topic, to say the least. So for those of you who want a deep dive into this elephant in the room that took down SVB, that took Wall Street by surprise, and that may take more banks by surprise during this ongoing banking crisis, I've linked this video in the description below for your viewing pleasure. So, now what? Right. So here are the 5 signs that your bank may be in trouble, summed up in this handy table. Now, simply answering yes to any single one of these questions is not enough, at least not enough in my mind, to necessarily make a determination of your bank's future. Plus, as I always say, everyone's financial journey is different, and that holds true for banks as well. So we will refrain from jumping to any conclusion too fast. That said, answering yes to 2, 3, or possibly all 5 of these questions, and depending on the magnitude of change over the previous year's numbers, it may help provide you with some insight as to the direction your bank is potentially headed. And do note that these are the signs that we look for in assessing the health of a bank. Other folks in the industry may have other questions that they ask in making their own determination. What about you? What do you think are signs of a healthy bank versus one that's in trouble? Who do you bank with? And how happy, comfortable, and or safe do you feel about having your money there? Drop a comment below and let me and the other super savers know. As to the question of whether First Republic will survive this week, this banking crisis, you should know that FRB is exploring options such as selling assets or the creation of a bad bank, a crisis mechanism for isolating problematic financial assets. According to Reuters and CNBC, First Republic's advisors have approached at least 4 of the large banks that handed them the $30 billion of uninsured deposits as a lifeline in March with a proposal to buy some of the bank's assets. However, 3 of those banks have said that they don't see a way forward without government support. It appears, though, that U.S. government officials are currently unwilling to intervene in the First Republic rescue process. And to be honest, things aren't looking so great at the moment for First Republic if they don't come up with a reasonable plan soon to restore public confidence. Their stock hit another all-time low at the time of this taping. Now, the data I've shared with you today is publicly available, and I've linked all my sources in the description below as stated earlier. But even when found, for the average person, or frankly almost anyone who's not a specialist, these numbers are not so easy to piece together, analyze, and understand. So when everything is done and dusted, and I know I sound like a broken record, but someone has to do it. When everything is done and dusted, the best thing we can all do to protect our hard-earned savings at our bank is to stay below the FDIC threshold of $250,000 per depositor, per FDIC-insured bank, per ownership category. And for those of you watching this who may bank with First Republic, do remember that First Republic is an FDIC-insured bank, so your hard-earned savings are FDIC protected there, so long as you stay within these FDIC insurance limits. At the end of the day, everyone's financial journey is different, so you need to do what's right for you and what helps you sleep better at night. For those of you who haven't seen our FDIC 101 video yet, check it out here to learn more and see how you can increase your FDIC insurance in certain instances with your bank. All right, Super Savers, so I hope you enjoyed this video and learned something new. As always, if you did, don't forget to share with those you care about, and of course, hit that thumbs up, and see you again very soon with another brand new wealth building video.